A few weeks ago, I sat down with a close friend of mine. He'd just gotten his Social Security statement in the mail. Projected benefit of $3,500 a month. He was already talking about travel plans. Portugal, maybe Japan. I asked him one question: have you looked at what you'll actually take home? He hadn't. Most people don't. So we sat there, and I walked him through the numbers. His Social Security, $42,000 a year. Add in the IRA withdrawals he was planning, and just like that, up to 85% of that Social Security income becomes taxable. Not all of it, but most of it. The IRS has a formula for this, and it doesn't care how long you waited, how hard you worked, or how carefully you planned. His smile faded pretty quickly. I'm not sharing this to scare you. I'm sharing it because this is the part nobody talks about. You can find 100 videos explaining how to get to $3,500 a month. Very few of them explain what happens after the check arrives. Because there's a difference between the number on your SSA statement and the money you actually spend. That gap between gross and net is where retirement plans quietly fall apart. So before we get into strategies, let's get honest about the math. How does Social Security actually calculate your benefit? And once you understand the formula, we'll talk about why reaching that number might cost you more than you think. Most people think Social Security is simple. You work, you pay in, you get a check. But the actual formula is more layered than that, and understanding it changes how you plan. Let's start with the foundation. Social Security looks at your 35 highest earning years, not your total career, not your last salary, your best 35. If you worked fewer than 35 years, the missing years get counted as zeros. That matters more than people realize. 1 or 2 0 years can quietly drag your average down. Those earnings get adjusted for wage inflation over time, then averaged into a single monthly figure called your AIME, your average indexed monthly earnings. This is the number the formula actually works with. From there, Social Security applies what's called a bend point system. Think of it as 3 tiers, each with a different rate. For 2026, the first $1,286 of your AIME gets replaced at 90%. The portion between $1,286 and $7,749 gets replaced at 32%. Anything above that gets replaced at just 15%. That's the progressive part of the formula, and it's intentional. The system is designed to replace a higher share of income for lower earners. The more you made, the smaller the percentage you get back. Here's what that means in practice. To land a benefit in the $3,300 to $3,500 range, your average annual earnings across your best 35 years generally need to be somewhere between $100,000 and $125,000. Not your peak salary, your sustained average over decades. Do a quick check, take your career earnings, pick your best 35 years, average them out. If there are gaps, time out of the workforce, lower income years, years before you hit your stride, those zeros or low numbers are already pulling your AIME down. There's also a ceiling worth knowing. In 2026, only the first $184,500 of your income is subject to Social Security tax. Anything above that, you stop paying in, and it stops counting toward your benefit. So if you spent years earning well above that threshold, the additional income above the cap didn't build your benefit at all. The system is structured this way on purpose. It isn't arbitrary. But understanding the structure tells you something important. There's a point of diminishing returns built into the formula. Past a certain income level, every additional dollar you earned returned less and less in future benefits. If you were a high earner, a significant share of what you put in over your career is simply not coming back. That's not a complaint, it's just the math. And knowing it helps you stop chasing a number in isolation and start asking the right question. Given your actual earnings history, what benefit can you realistically expect, and what does that leave you to work with? Now, let's say you did the work. You hit $3,500. You waited, you planned, and the number looks right. This is exactly when the next problem appears. My friend got his statement. $3,500 a month, $42,000 a year. He did the math on his retirement. The travel, the mortgage payoff, a little left over. It all worked on paper. What he didn't account for was what happens when that $42,000 sits next to everything else he's pulling in. This is where a rule called Provisional Income comes in. It sounds technical, but the idea is straightforward. The IRS doesn't just look at your Social Security check when deciding how much of it to tax. It adds up your Social Security income plus any other income you have, IRA withdrawals, interest, dividends, part-time work, and uses that combined number to decide your tax exposure. For a single filer in 2026, once that combined figure crosses $34,000, up to 85% of your Social Security benefit becomes taxable income. Not 85% taken away, but 85% added to your taxable base at whatever rate applies to you. Run the numbers quickly. $42,000 in Social Security. Add $30,000 in IRA withdrawals, a conservative figure for someone with a decent nest egg. That's $72,000 in combined income. You're well past the threshold. Most of that $42,000 is now being taxed. For someone in the 22% federal bracket, that's roughly $8,000 in federal tax on income they thought was their reward for decades of work. The check says $3,500. The take-home looks a lot more like $2,800 or less, before state taxes. I used to think that maximizing your Social Security benefit was the obvious goal. Just wait, collect more, done. Then I watched clients hand back nearly a quarter of it to the IRS and Medicare. That changed how I look at this, because there's a second layer most people miss entirely, IRMAA. Medicare isn't free in retirement. Most people pay a standard Part B premium. But if your income crosses certain thresholds, the government charges you more, sometimes significantly more. In 2026, the IRMAA surcharges for individuals kick in around $109,000 in modified adjusted gross income. Here's what makes this painful. The thresholds work in hard steps, not gradual slopes. Go $1 over the line and your Medicare premium jumps, potentially by several $100s a month. That's not a marginal increase. That's a cliff. So think about what can happen when everything hits at once. You retire. You start drawing Social Security. You take an IRA distribution to cover a home repair or help a kid with something. That one withdrawal pushes your income just past $109,000. Suddenly, your Medicare bill for the year is thousands of dollars higher than you planned. Trying to squeeze out an extra $500 a month in Social Security by waiting longer can cost you more than that in taxes and Medicare surcharges if your other income isn't managed carefully alongside it. The benefit number goes up. The net amount you keep doesn't always follow. This is the gap between the gross number and the real one. And it's why the strategy has to look at the whole picture, not just the Social Security line in isolation. The money you actually spend is what matters, not the number on the SSA website. And if you're planning for two people, this gets more complicated and more consequential than most couples realize going in. There is no single question in retirement planning that gets more attention than this one. And there's a reason for that. It's genuinely consequential. And the right answer is different for almost everyone. Let's lay out what we're actually talking about. You can start collecting Social Security as early as 62. If you do, your benefit gets permanently reduced, roughly 25 to 30% below what you'd receive at your full retirement age. For most people born after 1960, full retirement age is 67. If you wait past 67, your benefit grows by 8% for every year you delay, up to age 70. That's the delayed retirement credit. It stops accumulating at 70, so there's no reason to wait beyond that. The difference between claiming at 62 versus waiting until 70 can be as wide as 74% on the same earnings record. Two people with identical work histories, identical contributions. One walks away with roughly $3,000 a month, the other with over $5,000. Same person, different timing. Now here's the comparison most financial content stops at. If you claim early, you get smaller checks, but more of them. If you wait, you get bigger checks, but fewer years to collect them. The crossover point, where the total lifetime payout from waiting finally overtakes the total from claiming early, usually falls somewhere around age 80 to 82, depending on your specific numbers. So the math on waiting looks clean. If you live past 82, you come out ahead by delaying, but that framing leaves something out. Wanting to claim at 62 isn't impatience. For a lot of people, it's a reasonable response to real uncertainty about health, about how long the body holds up, about not wanting someone else's timeline to dictate when you access money you spent decades earning. That instinct deserves respect, not a lecture. What it does need is an honest look at the full picture, because here's what the simple break-even calculation doesn't capture. When you delay to 70, you're often spending down other assets in the meantime. Taxable accounts, savings, maybe Roth funds, to cover living expenses while you wait. That money is no longer compounding. So the real break-even isn't just about Social Security in isolation. It's about what you gave up to get there. On the other side, claiming at 62 while still working, even part-time, can trigger the earnings test. If you're under full retirement age and earn more than a certain threshold, Social Security temporarily withholds part of your benefit. You do get it back later, but it complicates the cash flow. There's also the health variable, and it's worth saying plainly. If your family history or current health suggests a shorter horizon, waiting to 70 for a larger check may never pay off mathematically. The standard advice to always wait ignores this. Your situation is not the average. Here's what the comparison actually comes down to. Claiming at 62 gives you control and certainty, smaller amounts, but yours now. Waiting until 70 gives you longevity insurance. The kind that matters most if you live well into your 80s or beyond and your other assets start running thin. Neither is wrong by default. What's wrong is making the decision based only on the Social Security number itself, without looking at what else you're drawing from, what your spouse's situation looks like, and what the tax picture does when income from multiple sources stacks up. And that last part, the spouse piece, is where the conventional wisdom about waiting until 70 can quietly become a problem. Most retirement planning conversations focus on one person's number. How do I maximize my benefit? When should I claim? What's my break even? But Social Security for married couples is really two checks. And what happens to those two checks when one person dies is something most couples have never sat down and worked through. Here's how it works. When a spouse passes away, the survivor keeps the larger of the two benefits. The smaller one disappears, not reduced, gone. A household that was living on $5,500 a month in combined Social Security suddenly has $3,500 or less. I think about a woman I'll call Mary. Her husband John had waited until 70, done everything right. His benefit was $3,200 a month. Hers was $2,500. Together, $5,700. Enough to cover the mortgage, the utilities, the Medicare premiums, and still have a little room. John died 14 months into retirement. Mary kept his check. Hers went away. Overnight, the household income dropped by more than $2,500 a month. But the mortgage didn't drop. The heating bill didn't drop. The insurance didn't drop. Those fixed costs, the ones built around two people living in a house, they stayed almost exactly where they were. She told me she sat at the kitchen table the following January, looking at her first tax return as a single filer. That was the other thing nobody had warned her about. When you're married, you file jointly. The tax brackets are wider. The thresholds for Social Security taxation are higher. The moment John was gone, Mary became a single filer, and the IRS treats single filers very differently. The same $3,200 a month that was minimally taxed as part of a joint return was now pushing her closer to the 85% provisional income threshold on her own. Her tax bill went up the year her income went down. This is sometimes called the widow's tax penalty. It's not a conspiracy. It's just the way the brackets are written. But it lands hard at the worst possible time. Run the numbers for a moment. A couple with $5,700 in combined Social Security plus modest IRA withdrawals might have kept their tax exposure manageable. The surviving spouse, with $3,200 in Social Security and the same IRA withdrawals, crosses the provisional income threshold faster as a single filer and faces a higher effective rate on a smaller income. Household spending doesn't fall proportionally either. Research consistently shows that a surviving spouse typically needs somewhere between 70 and 80% of the couple's prior income to maintain the same standard of living. But the income drop from losing one Social Security check is often 30 to 50%. That gap has to come from somewhere, usually savings, sometimes from selling the house sooner than planned. None of this means that waiting until 70 is the wrong call for the higher earner. In fact, for many couples it's the right one, specifically because that larger benefit becomes the survivor benefit. But the decision has to be made with both people in the room and with the full picture on the table. What does the income look like for the one who's left? What does the tax situation look like? What are the fixed costs that don't shrink when the household does? Maximizing your own number without running that scenario isn't just incomplete planning. It's planning for one outcome when you need to be ready for two. Retirement isn't a solo event, and the decisions you make now about timing and sequencing will follow the person you love into a future you won't be there to help navigate. So what do you actually do with all of this? You've spent decades building something. The goal now isn't to maximize a single number. It's to protect what you've built from the parts of the system that quietly work against you. 3 things worth doing before you make any claiming decision. First, look at your other income sources before you touch Social Security. If you have a traditional IRA or 401k, every dollar you pull out in retirement adds to your provisional income and pushes more of your Social Security into taxable territory. A Roth conversion, moving money from a traditional account to a Roth before you retire or before you claim, can lower that taxable income in your later years. It costs you taxes now, on your terms, rather than letting the IRS collect on theirs. Second, Run the break-even calculation for both spouses, not just yourself. When does waiting pay off for you? When does it pay off for the survivor? Those two answers are often different, and the gap between them is where the real planning happens. The goal isn't the highest individual benefit. It's the most stable income floor for however long this lasts, for either of you. Third, before you finalize your claiming age, get a clear picture of where your total retirement income will land relative to the IRMAA thresholds. A single poorly timed IRA withdrawal in the wrong year can push your Medicare costs up by hundreds of dollars a month. This isn't something most people find out until after the fact. Knowing the thresholds ahead of time gives you room to manage around them. None of this requires a perfect plan. It requires an honest one, built around your actual numbers, your health picture, and your spouse's situation, not a general rule of thumb that was designed for someone else's circumstances. If this helped you see something you hadn't considered before, subscribe to Wes Investor. This is exactly the kind of thing we cover, the gaps between what the system shows you and what it actually delivers. The fine print that doesn't come with the statement. You work too long and too carefully to lose ground to something you could have seen coming.